2,888 crore rupees. That is what this company earned in revenue in 1 year. An almost completely unknown stock generating nearly 3,000 crore, and most retail investors have never even heard the name. And here's the number that actually stopped me cold. From the COVID low to today's all-time high, this stock turned 1 lakh into 6.9 lakh, 116% return in a year. A power infrastructure company, and the cycle driving it hasn't even peaked yet. Here's what this business actually does. Every time a light switches on in India, every time a factory machine fires up, every time a new data center goes live, somewhere in that chain is a transformer, a switchgear, a smart grid system. This company makes all of that. It's the unsung backbone of India's entire power network. Zero debt, 40% return on capital, backed by a 37 billion euro global giant holding 75%, and they haven't sold a single share since 2012. But I'm not telling you the name yet, because once you understand what this business does, the name is going to hit completely differently. First clue, the parent company is European, Fortune 500, one of the most powerful energy brands on earth. Every substation in India needs it. Every data center going live right now needs it. Every metro rail electrification project needs it. Transformers, switch gears, smart grid software that self-heals. This company makes the physical backbone of India's power network and then sells the software brain on top of it. Hardware plus software plus recurring service contracts. That's a moat most Indian industrials don't have. And the margins prove it. EBITDA margin went from 5% to 14.5% in 4 years. That's not luck, that's pricing power compounding. My second clue, it's NSE listed, 9-letter ticker, parent headquartered in Paris. And in Q3 FY26, just now, it had the highest single quarter revenue in the company's entire history, over 1,000 crore rupees in 1 quarter. Can you guess what this stock is?
Schneider Electric Infrastructure Limited, NSE Schneider. And yes, this is not the parent's broader India operation. This is the separately listed subsidiary, the one you can actually buy on the exchange. This is the stock I want to cover today. And stay tuned, because it's something that most of you have never considered. The broad snapshot is this: 29,700 crore rupee market cap, 28,088 crore rupee TTM revenue, 75% promoter holding, 40.9% ROCE. The parent is Schneider Electric SE, Paris, 37 billion euros, Fortune 500, CAC 40. 2 plants, Vadodara and Naini, 1,400 employees, capital light, backed by global R&D, and sitting right in the middle of India's biggest infrastructure capex cycle in decades. अब numbers में जाते हैं, because the growth story is where it gets really interesting.
FY21 revenue 1,297 crore rupees. FY25 2,637 crore rupees. That's a 19.3% revenue CAGR over 4 years. Steady, consistent, not a 1-year spike. But here's the number that made me stop scrolling. Q3 FY26, 1,029 crore rupees in a single quarter, the highest quarterly revenue in the company's history. Year-on-year growth of 38% in that quarter alone. And look, TTM revenue is already at 2,888 crore rupees, meaning the next full year print will almost certainly cross 3,000 crore rupees. That's a psychological milestone, and the market will notice. The order pipeline management flagged in the Q3 earnings call, multi-year high. Data centers, utilities, railways, exports, all firing at the same time. This isn't one tailwind, it's 4. Wait, it gets better. The margins are what really seal this story.
Let's go over the profitability. ROE 49%, 3-year average 109%. Let that sink in. For every 100 rupees of shareholder equity, this company generates 109 rupees of profit on average. That's elite territory. ROCE 40.9%, PAT margin of 10 to 11%, compounding at 59% for 5 years. The main thing here is the EBITDA margin in FY21 was 5.2%. By FY25, it hit 14.5%. PAT margin went from 1.2% to 9.3%. This is a company that figured out its own operating leverage and then executed on it year after year without missing a beat. Debt-free, operating cash flow positive 3 years running, working capital tightening, DSO down from 95 days to 72 days. Every quality indicator is moving in the right direction. Zero dividend, ये सब reinvest हो रहा है. And given a 59% profit CAGR, you're not complaining about that.
And what about its revenue? Revenue breaks down into 3 buckets. Products 48%, systems 38%, services and software 14%. That 14% is the most important number here because that's recurring, sticky, high margin revenue that competitors cannot easily replicate once you're embedded in a customer's facility. Now the growth drivers, and this is where the story gets structural. India has committed 3.45 lakh crore in power grid capex between FY24 and FY28. The 500 gigawatt renewable target by 2030 needs grid upgrades. Indian data center capacity is set to triple by 2027. Railway electrification is hitting 100%. Every single one of these is Schneider Electric Infrastructure's end market. Not one tailwind, 4 simultaneously. And Q3 FY26 management commentary confirmed order inflows at a multi-year high. Execution cycle is 6 to 18 months. So what's being ordered today becomes FY26 and FY27 revenue. Visibility is strong. A valuation payout, because this is where most investors get confused.
Okay, real talk. This stock is not cheap. PE of 121x, PB of 45x, EV by EBITDA around 64x. At these multiples, the market is already pricing in continued strong execution. One bad quarter and this thing falls 20%. That happened in Q1 FY26, lower circuit, single session. Here's the context. Hitachi Energy India trades at 170x PE, CG Power at 115x, sector average is 77x. Growth investors can justify the premium if execution continues. Value investors should wait for a correction, and those do happen here. The question is, do you have conviction to hold through the volatility? I'll go through what I think's best for most people at the end of the video, so stick around for that. Now the shareholding pattern. Let's look at who is holding the stock and why it matters. 75% promoter, Schneider Electric France. Hasn't sold since the 2012 listing. That's 13 years of zero promoter selling, the strongest possible signal of long-term conviction. FII holding, just 3%. This is a counterintuitive insight. Low FII isn't a red flag, it's an opportunity. When global institutions start paying attention to India's power infrastructure story, and they will, the buying pressure from FII accumulation alone can be a significant re-rating catalyst. That's room that doesn't exist at stocks where FII is already at 20-25%. DII at 4%, public retail at 18%. The institutions haven't fully arrived yet. No dividend since 2012. Management's message is clear. Every rupee goes back into growth. With a 59% PAT CAGR, that's been the right call. Fundamental analysis के बाद technical पे आओ. From 185 rupees in March 2021 to a 52-week high of 1249 rupees. That's the journey. The 780-850 zone is a well-established support band. Entry zone for new positions, 850-880. Stop loss, 780. If that breaks, the structure changes and you reassess. What I've noticed is, this is actually one of those charts where the fundamental story and the technical setup are both pointing in the same direction at the same time. That alignment doesn't happen often. Now let's go through some of the risks of this stock. No sugarcoating. First up, valuation. PE 121x means zero margin for error. One earnings miss and this stock drops hard. It happened. Q1 FY26 a lower circuit. Premium valuations punish mistakes severely. Raw material inflation. Copper, silicon steel, transformer oil, these are volatile inputs. A commodity spike directly hits margins. Q1 FY26's miss was partly this exact issue. Watch commodity prices every quarter. Execution delays. The order book is strong, but orders only become revenue when projects are delivered. Government approvals, site readiness, logistics, all can push revenue recognition by a quarter or two. Chinese competition. Low-cost Chinese switchgear and transformer imports are a background threat. If anti-dumping duties get relaxed, SEIL's pricing power takes a hit. Policy risk, always watch. Last, related party concerns. The parent also competes in the Indian market directly. Transfer pricing and related party transactions need scrutiny every quarter. These risks are real. They are not deal breakers today, but they are the things that can make this stock extremely volatile. Eyes open, eyes on.
आओ wrap up करते हैं. Bull case first. India's power capex is a 10-year structural story. SEIL sits right in the middle of it. 59% PAT CAGR, 40.9% ROC, debt-free, smart grid software moat, 75% promoter not selling. FII under ownership means a future re-rating catalyst is waiting, and Q3 FY26 just posted a record quarter. But what about the bear case? PE 121x leaves no room for error. Raw material spikes can destroy margins quickly. Execution delays are real. Q1 FY26 proved it. No dividend means you're entirely dependent on price appreciation. Small float means illiquidity when everyone wants out at once. My verdict is cautious buy. Strong business, real tailwinds, premium price. Don't FOMO in at any price. Accumulate near 850, 880, keep a stop at 780 and give it a minimum 2-3 year horizon. SIP approach is better than lump sum here given the valuation risk. Now, if you've been watching this channel and genuinely want to stay ahead of the curve, subscribe. We track stocks like this every single week. Companies with real fundamentals, structural tailwinds, and enough under-the-radar positioning that there's still time to act before the crowd arrives. If that value exchange makes sense to you, hit the subscribe button. As always, this is not financial advice. One question for the comments. Were you already holding this stock, or is today literally the first time you've heard of this company? I genuinely want to know the ratio. Drop it below. Thanks for watching.